love the channel and find it useful in becoming a happy retiree. Subscribe today. Really going through, I think, some sort of iteration of folks that are nervous about getting invested in this market because it's at a point where you look at the Dow that bottomed in the 6,000 range, 7, 8, and we've climbed so far from that trough that happened in 2009, and we've gone through 19 and 20 and 21 and hit 22,000 not long ago, and we were hovering around those levels today, and you get new money or you have some sort of investment, you end up in this investment conundrum. You say, well, do I put money to work today? Because it's not a good idea, Wes, right? To put money to work at a market high. We did an economic history lesson in the last couple of weeks and talking about even bad timing for stocks, even if you get to work right away. And this is what I wrote about for the AJC that'll be out on Tuesday in the front of the living section. Even if you have really bad timing as an investor, it still beats sitting around in cash as long as you've got 5 years, 7. Of course, longer is better. And the study that we've gone through over the last couple of weeks is an indication of looking at 5-year and 7 and 8 and 15 and 17 and 25-year periods. Of course, the 25-year period handily, it crushes cash, even if you have bad timing. But even shorter periods of time, and I look at short as an investor, I'd say that's 5 years. You think, oh, what's short term? Next week. I say short term. When somebody says short term to me, I think 5 years is still short term. Over time, that if you've got a little bit of time in markets, equity markets will trump cash when given time, as long as our economy continues to grow. And I don't see any reason why it's not going to grow over the next 10 and 20 and 30 years. And that's what's so important. And that's why I focus so often on economic data, because I'm really watching to see whether we're going to continue to grow, what demographics look like, are we going to head into a recession? And if we're going to head into a recession, how significant is it going to be? Because that's really what's the underpinning of how whether companies earn money or lose money. And that's what drives stock prices. So that's why very often the focus here on Money Matters is an economic focus. I want to talk about valuation for a minute. Again, super quick recap. We talked about the last couple of weeks that effectively being in the market over time, even if you have bad timing in stocks, if you have time, still beats cash. So I looked at 25, 17, 15, 8, 5-year periods. In every case, even the worst timing you could have buying into stocks still beat cash, or still best cash, if you will. Over 25 years, even the bad timing beats cash by 381%. Over 17 years, bad timing beats cash by 80%. Even staring into the abyss before the financial crisis, if you got invested in that period of time, which would be terrible timing, your stock market return, S&P 500, still beats cash by 54%. So you get that. But it is important to understand that paying, or historically paying less for stock earnings, paying $10 for a dollar of earnings versus $30 for a dollar of earnings, leads to better results over time. So yes, time is the most important matter in investing. And in a perfect world, we'd only get invested when market valuations are low, but we don't have that luxury because market valuations can stay slightly elevated for years and years and years. So when I want to walk through why valuation, though, which is expressed, we're going to really be talking right now about price to earnings ratio. Why PE, price divided by earnings, why that matters. And I'm going to plug that into the bigger picture. What is PE? In the simplest form, it's just the market's level, so the price of the S&P 500 in this case, or a stock's price, depending on what you're measuring. You can get PE for the whole market or an individual company, divided by a dollar number. And that dollar number is earnings. So expected earnings over the next year, $135 for the S&P 500. The S&P 500 level is roughly 2,400. You divide 2,400 by 135 and you get 17.75. Let's call it 18. So think of it in odometer terms. 2,400 is the odometer's level. 18 is what we're paying for that odometer level. The number 18, the price we are paying for that odometer reading or level, is really the key. So price to earnings, or PE, is essentially what we're paying for every dollar of earnings. And that's really what's important as an investor. And historically, when valuations are low, we're better off as investors getting into stocks. Well, why? Well, because that means stocks are cheaper. They're less expensive relative to what they're earning. And cheaper is the operative word. Another way to look at this is to consider how much you're paying. Again, how much are you really paying for earnings? If we're paying $10 or $15 or $30 per dollar, the lower number historically is better. And I went back again to our friends at the Ned Davis Research Group, effectively a stock market history think tank, data think tank, and analyzed forward stock market returns when you get invested at different valuation levels. I wanted to see, well, what do you do over the next year on average when the PE ratio is high versus intermediate or middle range versus low? Here's what I found. Let's take a look at the data of the various odometer levels relative to what we pay. And then what do we earn over the next year? So let's think of it as the sticker price. So that's our sticker price. Is I'm going to just pay what let's call it suggested retail value. There's a sticker price on the car. So sticker price is just the retail value. So you can pay that price, sticker price, or you can pay below sticker price, or you pay above sticker price. So let's think of it to some extent as a car analogy. So let's think of it as stocks. Let's start with stocks are on sale. Call this below sticker price. When valuations are low, and this is in the range of 9.5 times or lower. So I'm paying 9.5 times for earnings, or less than that. It could be 8, could be 7. My expected returns are really, really high. So to the tune of, on average, 20% per year rate of return in markets when I'm paying below sticker price. And that makes sense because you're getting good value. When stocks are at sticker price, let's call them fairly valued or fully valued or appropriately valued, the PE ratio, price to earnings, now that's in a range of 9.5 to 16.5 times. Expected returns come in at around 5% a year. So okay returns, not great, okay returns. When I pay above sticker price, and in this scenario, valuations are let's say 16.5 or more, meaning that PE ratio is high, returns over the next year are relatively flat. Historically, they're not negative, they're just flat. Incidentally, that's where we are today. We're just north of sticker price levels. We're at around 18. So while today's market is at a historically high level, what really matters, the level matters less than what we're paying for that level. So back to this analogy, we're paying a bit more for the odometer level these days than we'd like to see. Not tremendously more, just a bit more. And an important point to remember is that we don't stay at any of these three ranges listed that I just talked about. We don't stay there forever. We move in and out of these categories as the market changes and the market shifts. So valuations, yes, they matter. But what also matters, of course, is spending time throughout all those three categories. Think about it. To control your point of entry and only be in markets when valuations are at a low point, you'd have to time the market perfectly, and not just once, but you'd have to do it over and over and over again. And we know that's a really difficult, it's almost an impossible game. It's almost impossible to foretell the market and to control valuations and your entry point. That's difficult. But your own discipline and your own participation, that's a lot easier to control because that's up to you. So just remember that investing success is less about perfection, and it's more about participation. It's less about perfection and more about participation. And if we can remember anything, so today we're at 17, 18 times earnings, a little just in that above sticker price range, not tremendously though. Go back into some of the market peaks though. Look at 1998. The market's traded at 30 times earnings, almost double as expensive as where we are today. The year 2000, we traded at 36 and a half times earnings, more than double the valuation where we are today. In 2007, the market multiple got to 24 times earnings. So even though we're a little elevated today, slightly above sticker price, there are historically, you go back to what set up big market corrections, valuations were much, much more stretched than where they are today. So at 30 and 36 and a half and 24, those were the previous market peaks. 98, the year 2000, 07, all of those periods of time right after the market peaked at this giant overprice, way over sticker price, that's when we got 20% and almost 50% corrections. I think we put all this into context. Remember, markets are not cheap today, so we're not getting a great value. So we don't expect 20% returns like we would if we were buying at 9.5 times. We're at 18 times. Earnings would over the next year about $135 for the S&P 500. So all that to say, we're slightly fully valued to slightly overvalued. It's not the perfect time to invest, likely. But it's also not a terrible time to invest. If you go back to history, valuations can be a lot more out of line, i.e. 08, 2000, 2007, than where we find ourselves today. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.